Okay. Good morning, everyone, and thank you very much for joining us on the Inheritance Tax Planning and Business Relief webinar hosted by Blackfinch Investments. My name is Anna Brooksbank. I'm the Senior Business Development Manager for Yorkshire and the North East, and I'm joined on the line this morning with Gordon Pugh, who is our Investment Director and Real Assets Portfolio Director. First of all, I want to say thank you very much to everyone for joining us at 10 o'clock on a Monday morning to talk about tax planning. But a particular shout out to the England fans. If you happen to stay up until 1 o'clock with a final kickoff at 2 a.m. due to storms, I think it was, and you're still here at 10 a.m. to hear us talk about inheritance tax, then I applaud your dedication to the cause. Thank you very, very much for being here. I have heard that we did win though, so hopefully it was a good night for everyone. Before I kick off the session, I do have to show you the all-important T's and C's, the important information. Under no circumstances whatsoever can Gordon and I give you any form of financial advice or tax advice. We have been in the industry for a very long time, but what we say today cannot be construed as any kind of financial advice. Furthermore, inheritance tax planning and business relief business relief in particular is a high risk investment. A lot of you on the call are familiar with it and are aware of it. We don't shy away from that. We are quite honest about it. But one of the reasons for having Gordon here this morning is to talk to you a little bit about how those risks are mitigated by the investment team. A little bit about the agenda this morning and what we're going to be covering. First of all, I'm going to kick off, pardon the pun, with a little bit about Blackfinch and who we are. I'm then going to talk about inheritance tax and business relief, give some of you a little bit of a refresher on what it actually is. I recognise there's a lot of knowledge on the call. So for some, it will be a bit of a refresher, and for others, it will be an introduction. I'm then going to pass over to Gordon, who will cover the Blackfinch Adapt IHT Service, which is our asset-backed version of our business relief service. And then he's also going to touch on our new insured option, which we launched earlier this year, which is very exciting. Then he'll throw it back to me and I will cover off some of the planning opportunities that are available when you're looking at business relief, investments and inheritance tax planning. Again, for some of you, it will be a bit of a refresher, but hopefully there'll be food for thought and you'll spot some opportunities for you and your clients going forward. If you do have any questions, please do put them in the Q&A, and I will, if I have time, I will come to them at the end of the session. If not, your business development manager will be in touch to answer any questions that you may have. The session does account for 60 minutes of CPD, which I know you'll all be happy about. At the end of the session, you will be asked to fill in a small questionnaire. In order to get your CPD certificate, you will need to fill in the questionnaire. We're quite strict about that. So, and you will be sent a link and a recording to the session as well. Learning objectives for this morning, I'm going to explain the rules around inheritance tax and business relief, and I'm going to touch on the new allowances that came into effect in April of this year. We're going to describe what business relief investments actually are and the structure of an asset-backed business relief solution. And then we're going to explain how the Blackfinch Adapt IHT service can be used. And then finally, identify the types of clients where business relief investments may be suitable. A little bit about Blackfinch though, and who we are first and foremost. We're built on an investment track record of over 30 years, which I'm very proud of. We've got an experienced team of over 150 people based out of our office in Cheltenham and dotted around the country. We've got decades of experience across various different forms of investing, including property and energy. And I am very proud of the fact that we are UNPRI signatories and we are committed to responsible investing. Hopefully you'll see that come through in some of the investments that Gordon touches on throughout the presentation. We are not just a business relief service provider. We have a multiple strings to our bow. We have the Blackfinch Adapt IHT service, which Gordon is going to focus on this morning. We also have our corporate management business relief service. For those of you that work with any corporate clients, we would be keen to talk to you about that. And we are also active in the VCT and EIS space. So if you are interested in any of those areas, please do get in touch. Also, on the other side of the business, we have a multitude of experience within asset management. If you are looking at reviewing your central investment proposition, we would be keen to talk to you. The team are incredibly knowledgeable and incredibly experienced in that part of the market. And I would very much encourage you to have a look at what they've got to offer because it is very compelling. So, inheritance tax planning. a growing opportunity and a landscape that is forever changing, as we've seen over the last couple of years. So, no surprises. I'm pretty sure I'm teaching many of you to suck eggs. Office of Budget Responsibility released these receipts earlier this year. In 2022 and 2023, we paid 7.1 billion in inheritance tax as a country, and it has slowly creeped up over the following years. So 2023, 24, 7.5 billion, 25, 26, 8.5 billion. And as you can see, that is an eye-watering amount of money that we are expected to pay in inheritance tax in 2030, 2031. 15 billion will be paid in inheritance tax. I personally think that's a conservative estimation brought out by the OBR. I anticipate it potentially being a little bit more than that, but even if it's not, that is still an eye-watering amount of money. The reasons for that, various different reasons. First of all, thresholds have been frozen since 2009. 325,000 does not get you what it once did. Property prices have increased steadily across the country, not just in London and the Southwest. That is creeping up the country. New rules coming in around farms and agricultural relief and business property relief that have come in over the last few months as a result of the 2024 budget. And of course, pensions, probably the biggest reason for the increase in inheritance tax that we've seen in the last few decades. And that is causing more and more estates to fall into the inheritance tax bracket. Not only will many estates be forced to pay inheritance tax, but because of the rules around pensions being included in the calculation for the residence nil rate band, many estates will also lose their 175, which is incredibly frustrating. I always include this quote in any presentation because I think it really does hit home. Inheritance tax, plus I find it a bit funny. Inheritance tax is, broadly speaking, a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. And that was Roy Jenkins, the former Labour Chancellor. I always wondered, did he mean distrust or did he mean dislike? Or perhaps the two are interchangeable. I'm not sure. But it is primarily a voluntary levy. So we know that the country has an inheritance tax problem. We know that that is increasing at a rapid rate, more due to various different reasons, including property and changes in legislation. But what is business relief and how does that come into it? Where does that factor into your planning and where are the opportunities? So a little bit of a refresher in the first instance. So formerly business property relief, it was brought into UK legislation back in 1976 when the then Labour government, yes, it was a Labour government that gave us business relief, realised that small businesses were being broken up in order to pay an inheritance tax bill, which from the point of view of UK PLC makes absolutely no sense. You break up a small business, people lose their jobs, local communities lose services, and fundamentally HMRC loses all the taxes that business pays, such as corporation tax, business rates, income tax, national insurance, etc. So back in the 70s, the government introduced legislation that said if you were a trading business, then you could pass that business down to the next generation and it would mitigate part of your inheritance tax bill. So fundamentally, it was introduced as a way to protect UK PLC. It applies to UK trading companies with some exceptions, and then in 1995 it was extended to AIM-listed companies, and then ISA holdings became eligible in 2013. There is the 2-year minimum holding for the required, so you have to hold them for 2 years and on death, and of course it requires HMRC approval. Business relief has been tweaked quite a bit over the last couple of years, but that's not the first time it's happened. So in 1976, when it was first introduced, you actually only got 30% of the relief. And it wasn't until 1992 that you got the full 100. It was in 1996 that the rules really did change, and the 100% relief was extended to minority investors in qualifying companies. So what that meant was if you were a private individual and you buy shares in a trading business, and you hold them for 2 of the last 5 years and on death, then the shares can be passed down to the next generation and it will mitigate your inheritance tax bill. So hypothetically, if my mother was to have an inheritance tax liability and she invested some money into a business relief qualifying business, held those shares for 2 of the last 5 years and on death, then the shares could be passed down to me, mitigating her inheritance tax bill. The benefit to her is it mitigates the bill. The benefit to me is that I get the shares that have qualified, but fundamentally the benefit is to UK PLC because she would be investing private money into a small business and that business would then be able to expand, potentially take on new people, expand, open a second shop, etc. So business relief is effectively a way to feed UK PLC. Of course, in 2013 and 2024, we have seen the rules change again, and caps have been brought in on business relief. So what did she actually do? What did Rachel do in the budget of 2024, and what has now come into play? So there was a time when you could put as much money as you wanted into business relief and you would get the tax breaks. There has now been placed a cap of 2.5 million. It was originally 1 million, but on the 23rd of December 2025, she gave us all a Christmas present. And now it is 2.5 million combined BR and APR, of which you can get 100% inheritance tax relief. Anything above that 2.5 million is taxed at 20%. Unused BR and APR allowance is now transferable. There was a worry at one point that it wasn't going to, but the 2.5 million is now transferable between married couples. So it is the same concept as the nil rate band. Sadly, there has also been a freeze on nil rate bands, residence nil rate bands, and the allowances until April 2031. So the likelihood is that inheritance tax receipts will continue to grow. What remains the same? Business relief, as applied to AIM shares, will be taxed at 50% from April 26. So AIM shares at one point did receive the 100% mitigation. Now they are taxed at 50% no matter the amount. And then, of course, as we know, the pension comes in April 27. Now what I'm going to do is I'm going to pass over to Gordon, who is going to talk you through the Blackfinch Adapt IHT service, how it works, some of the risks that we help and assist mitigate, and then he is going to touch on the insured option as well.
Thank you, Anna. Hello, everyone, and thank you for taking the time to join us today for this presentation. My name is Gordon Pugh, and I'm the Investment Director for Real Assets within Blackfinch. We'll be talking through how we go about making our deals across various trading activities and how we target consistent returns. So, why should you invest in the Adapt IHT service? We have three core objectives when it comes to Blackfinch Adapt IHT service. Firstly, that the trading activities that we undertake are qualifying for business relief, pretty much a given. Secondly, we believe that clients looking to invest in an unlisted business relief service are focused on preserving the wealth that they've created and delivering this through stability and low volatility. Probably the most important attributes of an unlisted IHT service are centered around predictable, stable returns that are asset-backed. The service has a number of key benefits, which include the IHT exemption of the shareholding after only 2 years. Clients retain access to their capital and can make withdrawals if they require. We focus on capital preservation, and we'll be looking at how we reduce volatility in the coming slides, as well as value for money in delivering a target return of between 3 and 5%. We'll also delve into the new insured option for those who wish to have a belt and braces approach to IHT planning through business relief. Investors invest through Buckley Trading Group Limited, and this allows for a dynamic asset allocation to the underlying trading activities. Being able to direct capital allows us to deploy funds into areas where we believe that those areas will yield long-term value for clients. There are a number of risk management techniques that we can put in place, which go a long way in order to achieve these attributes. We operate across a number of different trading activities, and those include renewable energy, asset-backed finance, property development finance, leisure, which is mainly hotels, home building or residential property development, and commercial forestry. The structure of the service also lends itself to the opportunity to add further trades in the future and further diversify our risk. As the portfolio is mainly in lending activities and energy, I'll be focusing on what we do in these sectors to differentiate ourselves and the framework to help preserve capital and give predictable returns. With regards to our lending activities, it is imperative that we are the senior lender and that we feature first in line if the borrower gets into financial difficulties. And that's why we always insist on having a first charge over the assets that we are lending against. Um, that in itself is not enough. We need to ensure that our exposure to any asset is sufficiently low so that in the case that a borrower does get into financial difficulty, there is also sufficient headroom left in the asset to enable us to sell that asset easily and also recoup both our capital and any interest that is owed to us. In terms of the energy sector, our risk management revolves around the type of technology as well as the location, which may not be as obvious as it sounds. In order to give us predictable returns in as low risk a way as possible, we only participate in UK mainland onshore wind and solar installations, thereby negating any foreign currency risk, country risk, and political risk, as well as ensuring that our assets are located in much more accessible areas than others. And this is, of course, all underpinned by a great deal of diversification in the underlying installations and lending deals, as well as by underlying counterparties. There are some core principles that we consider across both our property development lending and asset-backed lending trades. Those are that we will always be the senior lender and have the first legal charge securitized over the property that we are lending against. We look really to keep our exposure as minimal as possible, and whilst our criteria allows us to loan up to 70% of the loan to value, we are currently averaging around 60%. Further to this, where appropriate, and in most cases, we'll take a personal guarantee or corporate guarantee against the assets of those borrowers. We currently have 54 loans across the country with an average remaining duration of 11 months. Each lending deal that we complete has a fixed interest rate for the term of the loan. And when we look at our return profile a little bit later on, you'll see how this gives us predictability in that profile. Onto our energy portfolio, and I'll mention this again later, that we are only active in UK mainland solar and wind energy projects. And the portfolio consists of over 54 sites containing 75 assets nationwide. We do things a little differently, so it's good to explore what we do to differentiate ourselves from some of the competition. We do not operate in the spot energy market, and that's to say that we are significantly less exposed to price fluctuations as those who do operate in the spot energy market. We create stability and predictability of income and therefore asset valuation by fixing into short to medium term power purchase agreements. A power purchase agreement is just the name of the agreements used to sell our energy. And we do this with investment grade counterparties as well as on sellers. Household names such as EDF. The fixed pricing of these PPAs, which is typically fixed for 2 years, means that we have certainty of income and the level of income is diversified by project as each project has its own PPA. Each of those is entered into at a different point in time as those other PPAs of our other projects. So what this does is this gives us an average price for our energy production, and essentially it's pound cost averaging across energy sales. Therefore, we don't have any short-term fluctuations in our pricing. This creates stability, which we believe is a key driver for the IHT investor. And again, you'll see how this feeds into our return profile a little bit later on. This is all done through what we call Tier 1 technology, and I've mentioned it before, we only deal in UK mainland solar and wind projects. By way of background, all of our assets and loans are based on the UK mainland, which means we don't have any foreign currency risk, no foreign political risk. We've probably got enough of that here in the UK as it is, and we have no foreign manager risk. We like to keep it as simple as possible and as robust as possible from a tax and business relief perspective. And as you can see from this map, we have a wide geographic spread across the UK, minimizing the concentration risk that we have to any one area. This is extremely important, and I believe our IHT service is one of the few out of the main providers who ensure that we have no foreign asset exposure. One of the things we are proud of at Blackfinch is our consistency of returns and also our track record of liquidity. We have fact sheets available which detail our liquidity, and here you can see a snapshot of the sheet for Q1, which shows various metrics over the last 3 months, 1 year, and 5 year time periods. And this shows our funds raised, number of new clients, the average time that they've taken to withdraw their funds in calendar days, as well as the amount and the net annualized return after all fees, including advisor fees. And we're proud to say that we've been able to manage all withdrawal requests on a match bargain basis, which simplistically means that we've had more new clients coming into the service and more new money coming into the service than withdrawals. I mentioned earlier that one of the most important attributes of an unlisted IHT service is to have predictable returns, which we believe is what the majority of our clients who have built their wealth are after, i.e. protecting that wealth, and we believe that comes from low volatility. Here we can see the very predictable nature of the returns that the Blackfinch Adapt IHT service has produced since inception. We've placed this against the Numis index, which is more akin to the investments that you'd find in AIM portfolio services. And this is not to knock AIM portfolio services. It's just really a graph to highlight the low volatile nature of the Blackfinch Adapt IHT service, again giving investors that predictability of return profile that I've spoken about throughout this presentation. And that's fed through by the fact that we have fixed pricing in the sale of our energy assets and our energy production, and also the fixed interest rates that we have on the lending activities, and those give us that predictability. In terms of fees, here you can see the service details. The main points to highlight is that there's no annual management fee charged to the client that is dependent on performance. And if you might be aware of this, but a number of our competitors have an AMC which is contingent on performance. And that doesn't really align with capital preservation within an IHT service. Our dealing fee is 1% in and out. However, the exit dealing fee is waived on exit if the reason for that exit is death rather than an early withdrawal. But we will again waive this fee for withdrawals under 10%. Finally, the 1% dealing in fee is rebated if the client does not survive the first 2 years of investment, which we believe is good consumer duty. And to see how we stack up against the competition, oh, sorry. Oh, if you would like to see how we stack up against the competition, we do have a slide which details all of our competition and their fees, and you'll be able to actually have a look at that with your regional BDM. With those of you with current clients, we are in a rights issue period, which is running until the 24th of this month. The rights issue will allow clients to purchase 3 shares for every 1 share that they owned as at the 30th of March 2026. And for those of you who are not familiar with the rights issue, there are a number of benefits, but probably the main benefit to clients is that when they take up a rights issue offer, the shares issued under that offer are deemed to have been purchased at the same time as their original shareholding. So for a simple example, if your clients have held business relief shares in the Adapt IHT service for 2 or more years, their rights issue shares will be immediately exempt of IHT. If they've held their original shares for 18 months, then their entire shareholding, including the rights issue shares, will be exempt after a further 6 months of holding those shares. And similarly, if they've held their original shareholding for 12 months, their entire shareholding will be exempt after a further 12 months. This is extremely attractive and flexible for IHT planning. So, on to the new insurance option. This is the coming together of 2 different products to deliver a belt and braces approach to IHT planning. Clients can invest in the same strategy as just outlined in the Blackfinch Adapt IHT service and can benefit from optional 2-year life cover. And this 2-year life cover policy will pay out if the client does not survive the 2-year qualification period for their shares to become exempt of IHT. There are two options for cover, being cover for 20% or 40% of the investment amount, and this cover is for sums assured up to £400,000 on a single life basis or £800,000 on a joint life basis. Anna will go through a case study later on of why a client may choose 20% cover relating to transfers from AIM portfolios. There are two premiums to pay, the first taken from the subscription amount and the second being taken from the shareholding on the first anniversary of the policy. There are no premium price increases during the term, and cover is comprehensive with a slight caveat for single life investors in that the first 75 days are covered only by accidental death, meaning being hit by a bus, etc. But after that, full cover is given. On a joint life basis, full cover is available immediately and payout is on second death of the eligible member in the period of cover. Here you can see the fees as a percentage of the investment amount, and it is most likely that the right-hand table is the one that you'll be using for comparisons against any of our other providers. Please note that these fees are all in and there are no additional taxes to pay on top of these fees. This service is competitively priced and gives real options for diversification. So, who can qualify for the insurance? Anyone aged between 50 and 89 who is not diagnosed with a terminal or life-limiting illness and not undergoing related investigations. If you have clients who may fall into this catch-all bucket, there is the option to provide us with details of your client's conditions, and we can quickly assess whether they will be eligible or not, giving you further comfort on the policy. And in fact, we are working on an online tool to allow you to assess your client's eligibility and get an instant approval or not, making the process more seamless. And finally, and a bit of a game changer, this policy is available under power of attorney. I'll now hand back to Anna and thank you very much for your time. Anna, over to you. If Anna turns on her video and sound, we'll have her back. Here she is.
Apologies, I was talking to myself there for a second. Beg your pardon. Okay, thank you very much, Gordon. That was really useful. I think it's always a useful activity to hear from the people in charge as to how these investments and these services are actually managed to give you guys the peace of mind when you are recommending them to your clients. What we're going to do now is move on to the client planning scenarios. I'm going to talk you through some of the scenarios that I've seen live over the last couple of years, well, over the last 13 years, which is how long I've been doing this now. And hopefully it will give you some food for thought of the type of things to think about when you are recommending business relief to your clients. First, Gordon mentioned it, AIM to unquoted BR, replacement timelines. HMRC have actually confirmed this. If you currently have an AIM investor and you are looking to move them to asset-backed business relief, so they can move from a 50% relief to 100% relief, they will need to do their 2 years again. So if they currently hold AIM shares and you are looking to move them to asset-backed, they do not get the 100% relief overnight. They will have to do their 50%, they will have to do their 2 years again, which is why it's really important to remember that our insured option does have the 20% option rather than the 40% option. So if you've got clients that you think you want to move, but you're not 100% sure whether they're going to make the 2 years or not, they can take that extra option of the insured option as well. If you do have AIM cases at the moment on your desk, or you are considering moving AIM business over to asset-backed, do get in touch. We are currently offering a zero initial fee on AIM replacement cases, which means, as Gordon mentioned, you will be charged a 1% dealing fee, but no AMC on that investment. So it would be a 1% dealing fee, no AMC, and no exit dealing fee either if the investor dies holding the asset. And you can also get the cover. If you've got any of those that you're currently working on, please do contact your local business development manager. They would be thrilled to help you. Generational planning, flexible options in the event of death. So there's two ways that you can invest into a business relief investment, you can do it single or you can do it jointly. I'm a bit of a believer in doing two single applications. The reason being is that a married couple only has to live a combined 2 years in order for them to benefit from the business relief. So you've potentially got an opportunity to get any investment outside of the estate on first death. If you have a married couple and they do £100,000 investment as a joint name, when one of them passes away, the only place that can go is to the surviving spouse. However, if you have a married couple and they do 50,000 in individual names and one of them dies after the 2 years, sorry, they pass away after 2 years, then that investment can go down to the next generation free of inheritance tax. So by doing two single applications versus one joint one, you get the added benefit of being able to get it outside of the estate on first death. That becomes incredibly important if you've got clients that have estates of more than £2 million. As I'm sure all of you know, if you have a client that's estate is going over the 2 million mark, then they are losing their residence nil rate band. If you're able to get business relief outside of the estate on first death, then it could be that they can benefit from an estate of less than 2 million, and then therefore they are benefiting from the residence nil rate band. So in this case, it's not just a case of looking at what type of investment the client is doing and whether it's right for them. It's how the investment is actually placed becomes more important. Plus, it does mean that they can go down to the next generation, which is a potential future client for yourselves and your business. Mirror wills. I see this quite a bit with families where they have got mirror wills. If one spouse dies, it goes to the surviving spouse, and if one spouse dies, it goes to the surviving spouse. There is an opportunity to get more of the estate out on first death by using two single applications, but also do make sure that the business relief is not left as part of the residual estate. I've seen wills written up where the business relief shares are left as part of the residual estate, and therefore they end up being passed to someone who didn't have an inheritance tax problem. Do be careful of how the business relief is allocated for in the will, because it can have a massive effect on the beneficiaries and what level of inheritance tax is paid. There's very little benefit, if any, of leaving business relief to somebody who doesn't pay the inheritance tax bill. Leave it to the people that do, and therefore they can benefit for the inheritance tax breaks. Also be mindful when you're looking at wills of where the business relief shares are actually assigned to and where they go, and also what happens to them on death. It could be that you can benefit from a successive transfer. So in this case, Sarah invests in BR shares. She holds them for 2 years, so they do qualify. Sarah then sadly passes away, and her son Tom inherits the shares with 100% IHT relief. 1 year later, Tom sadly passes away, but he also benefits from 100% IHT relief because of successive transfers. So one important thing to look at when you're looking at business relief and when you're looking at will writing is be mindful of where it goes. Not only does it need to go to someone who could potentially pay the inheritance tax bill if they didn't inherit the business relief, but once they've inherited it, do they really need to disinvest? Or would it be more beneficial to them to hold it? So just be mindful of when you're looking at wills and where it's allocated and how it's used, that you might be missing an opportunity if it is disinvested or it's not allocated for properly in the will. Essentially, and rather strangely, I could talk to you all day about fancy planning opportunities with regarding business relief, and to several of you on the calls, I have actually done that. But fundamentally, a typical business relief client is elderly clients who are in poor health, and for whom 7 years can seem too long. Gifting is not an option for them, neither is trust work, because they've reached an age where the 7 years might not be feasible. As we know, business relief only takes 2 years. There is no medical requirements, no complicated questionnaires. There is the questionnaire on the insured option, but the standard option does not come with a complicated questionnaire. And of course, as we've already said, if it's a married couple, they only have to live a combined 2 years. It is also very quick and simple to set up. Furthermore, as Gordon mentioned, and I think personally, having been talking about business relief for 13 years, I think personally one of the reasons for the massive growth that we've seen in this area of the market is clients can change their minds. So in the event that they have a change in situation, or they need the money for other things, perhaps they want to go on holiday, have one last hurrah, then they do have access to the money should they need it. The asset is still in their name, the service is still in their name. So they can change their minds and they can gain control and access of the money should they need to. Furthermore, our business relief service is part of the direct payment scheme. So a lot of you will know that if there is an inheritance tax bill on the estate, that bill has to be paid ahead of grant of probate, which can be quite difficult for beneficiaries. If a client invests in the business relief service, then the beneficiaries can use the Blackfinch Adapt IHT service to pay the bill ahead of grant of probate, freeing up the money. Inheritance tax can be very difficult to pay in the sense of releasing finances from different assets, etc. Maybe it's tied up in property, etc. Not only that, it's quite an emotionally charged time when you've potentially just lost a loved one. Business relief can mean that you can pay the bill ahead of grant of probate. So when you're talking to clients, do ask them if there is a likelihood that they themselves are going to have to pay an inheritance tax bill at some point, because it could be that it's worth speaking to other members of the family to try and mitigate that situation or potentially add value in that way. Powers of attorney. I am seeing more and more of these cases crop up, and I have done over the last few years. It seems to be a growing area. As many of you will know, under power of attorney, there is not much you can do with regards to inheritance tax. You can't give money away, you can't make questionable investments, you can't go out and spend it, etc. You have to manage the assets and the finances in such a way that the settlor maintains their lifestyle and maintains access to the money and is being able to maintain their standard of living. However, under power of attorney, you can do a business relief investment. It is a straightforward investment on behalf of the settlor. It is low volatile, it's asset diversification. The client can retain access and control of the assets should they need it. One of the things to bear in mind is to start talking about inheritance tax planning with your clients now. It is possible to do business relief under a power of attorney, but it is best to start the conversations as soon as you possibly can. Not only that, I would also ask any of your younger clients if they are likely to have to pay, if they are likely to have to be a power of attorney for an elderly relative. I turned 40 this year, so I turned 41 this year, in fact. So it's unlikely, hopefully, that I will need my power of attorney at any time soon. However, it could be that I am a power of attorney for an elderly relative at some point, in which case it would be me that manages the estate. So I would encourage you to talk to any of your clients about them potentially being powers of attorney for elderly relatives or elderly acquaintances, because it would be them that manages the assets and manages the estate. And it could be there where business relief is a very, very powerful tool. And also, as Gordon mentioned, our insured option is accessible under power of attorney as well, which I think is a very powerful tool for you guys. We've mentioned already that under the rules, if you go over 2 million, you do start to lose your residence nil rate band. So rules came in back in, I think it was 2015. They announced the rules around the residence nil rate band, and it finally came into play in 2022. I may have my dates wrong there, but it does seem a very long time ago. The rule is that if your estate goes over the 2 million mark, you will start to lose your residence nil rate band. Business relief has always been included in that calculation. If you own business relief assets, they are included in the 2 million calculation made on death to decide how much an investor gets of that 175. It is now also the case that pensions will be included in the 2 million calculation. So I'm sure many of you will have clients that are not only going to be subject to inheritance tax on the pension, but the pension will also cost them part of their residence nil rate band. There is a planning opportunity for this, which I think could be quite useful for many, and I have seen it work in practice a couple of times over the last few years. So at 2.7 million, Mr. and Mrs. Adams have lost their residence nil rate band. So 2.7 million taxable estate, they've got 650,000 of their nil rate bands at 325 per person, no residence nil rate band, which means their inheritance tax bill is an eye-watering £820,000. Which hurts even more when you see it in writing like that, doesn't it? As a potential solution for this problem, what we can do is we can put £700,000 into BR qualifying assets. So, for example, the Blackfinch Adapt IHT service. You could put £700,000 into the service and hold that there for 2 years. And it will become qualifying. So after 2 years, the £700,000 is business relief qualifying. What you can then do is put the £700,000 of business relief into trust. Now, I'm sure all of you are aware, if you put more than £325,000 into a trust, you will be subject to a 20% chargeable lifetime transfer. Because that £700,000 is business relief qualifying, it is of zero value for the estate, and therefore the 20% CLT is non-applicable. So we've got the £700,000 qualifying for business relief, and we've managed to mitigate the 20% chargeable lifetime transfer when we've moved it into trust. Not only that, now that the £700,000 is in trust, we've also managed to mitigate some of the problems around the residence nil rate band. Because once the qualifying assets are in trust, they're no longer included in the 2 million calculation. So Mr. and Mrs. Adams' estate is now valued at 2 million. They've got some of their residence nil rate band back, and now the IHT bill has been reduced to £400,000. So we got the £700,000 BR qualifying. We managed to mitigate the CLT of 20% of everything, the 20% which would normally charge to everything over 325. The business relief is now held in trust, so it is outside the 2 million calculation, and for as long as it is held in business relief qualifying assets, there is no chargeable lifetime transfer. There is no ongoing periodic fees on it either. So there's multitudes of benefits to this planning scenario. So the point being is if you've got anyone who is over the 2 million mark, it might be worth taking a look and seeing if there's any way that you can move some of the money into trust and therefore benefiting from having some of that residence nil rate band back, which I think will become more and more important as time goes on. We've also already mentioned the impact of will provisions on inheritance tax planning, and it's becoming increasingly important. So Mike and Pat are married and have a combined estate of 3 million with ownership split equally between them. They each own £1 million in BR qualifying shares. I would just like to point out we're using £1 million here as an example. The average investment into an asset-backed business relief service is probably around 100 to 150,000, and the minimum investment is actually only 25,000. So we're using the number $1 million here to demonstrate the calculation, but the average investment, as I say, is around 100 to 150,000, and a minimum is 25. So you by no means need to be into the super rich bracket in order to benefit from business relief. But I digress. So Mike and Pat are married. They have a combined estate of 3 million with ownership split equally between them, and they each own £1 million of BR qualifying shares. Calculation on first death after April 26, estate value of 1.5 million. So the estate passes via deceased will to a surviving spouse. They've clearly got mirror wills. The estate value is 3 million. The business relief shares at 2 million at 100% BR because it's below the 2.5 million. They still don't get their residence nil rate band though, despite the fact that they've done 2 million to BR. They don't get their residence nil rate band. The standard nil rate bands do still apply though for 650. But we are still looking at an an IHT bill payable of £140,000. And this is a couple who have already done 2 million into BR and they're still having to pay the £140,000. So what can we do? Following a consultation with their advisors, Mike and Pat amend their wills to leave the BR qualifying shares into a will trust on first death. So calculation on first death after April 26, estate value 1.5 million. The business relief shares of £1 million are left into trust, so the residue passing to the spouse is £500,000. Calculation on second death, the estate value is at 2 million, plus we've got £1 million of BR shares available. We've got the 350 of the residence nil rate band, which we've earned back because we got the estate below 2 million on second death. We've got our standard nil rate band, which means we've been able to completely eradicate the inheritance tax bill. And that comes back to the point that I made earlier. It's incredibly important of how these assets are allocated in wills and trusts. Because if we've seen, here is a couple who did 2 million into BR and benefited from the reliefs available, but by simply moving them from one place to another on first death, we've been able to benefit even further and reduce the bill to zero. Final slide for you to think about in terms of case studies, people who've sold a business in the last 3 years. So the rules around business relief are that upon death, you have to have held the BR qualifying asset for 2 of the last 5 years and on death. Which means if you sell a BR qualifying asset, be it something like a business relief service, be it an actual trading business, or be it an EIS even, you have 3 years from the point you sign on the dotted line, not the point where the money lands in the bank account, from the point when you sign on the dotted line to get it reinvested, and it will qualify immediately. So we're seeing a lot of businesses being sold at the moment. I actually live in York, in the middle, in Yorkshire, which is very popular with small businesses and has been for many years. But there is a noticeable amount of businesses being sold or closing down due to, and in some cases, I know personally, the next generation not wanting to take ownership. So there is, I think, a lot more of these business sales happening across the country. Do bear in mind that if you do have an accountancy connection that you work with, this can be a brilliant example to work alongside them. In order to place business into the business relief service, they would need to speak to a financial advisor, which makes you a key component of the conversation. But yes, it is from the point they sign on the dotted line, they've got 3 years to get it reinvested and it will qualify immediately. So that is it in terms of the learning outcomes. So hopefully today what we've covered is explaining the rules around inheritance tax, business relief, and the new allowances that have come into effect since April 26. We've described what business relief investments are, and Gordon beautifully looked at the structure of asset-backed BR solutions and our new covered option. We've explained how the Blackfinch service can benefit clients and their estate planning needs. And then hopefully I've identified the types of clients where business reliefs may be suitable and some of the things that you need to think about when you are looking at these types of investments and the services, and hopefully pointed out some opportunities for you all. Alongside the products that we offer, we also have what can only be described as a buffet of resources and supporting materials for you all to use. We've got some beautiful brochures. The designs are lovely and they are written in a language that is easy to understand for your clients. We've got a wonderful guide to business relief. So if any of you are new to this area of the market, which many of you are due to the changes brought in by the budget, the guide to business relief is a great way to introduce it as a subject to clients. And then we've also got guides to estate planning. We've got power planning supporting material. We've got all the due diligence and suitability that you could possibly need when you're looking at these types of investments. And of course, we host what I hope are useful webinars on a regular basis. We've got client planning scenarios, advisor resources, and then we've got educational videos as well. If you're interested in learning more about forests and property loans and some of the renewable energy projects that we get involved with, then there is lots of resources for you to take advantage of online. Not only that, you have a team of incredibly knowledgeable BDMs from across the country that are there to support you. I did a quick tally, and between all of us, we have over 100 years of experience of working within the tax efficient space. Alarmingly, quite a lot of that is actually mine, but I'm still very proud of it nonetheless. We've also got a dedicated internal business development team who have a combined 40 years of experience of working within the tax space or within similar roles. And then we've also got a client excellence team who have a total of over 20 years of experience. Our client excellence team, in my opinion, are some of the best in the business. They are there to support you in the post-investment side of things. A financial advisor that I work with in Sheffield recently called them the best in the business, and he is not an easy person to keep happy, of which I have told him. Not only that, I'm very, very proud to introduce Laudable. Laudable, you may have seen in the news and in some of the marketing materials that we've put out in recent weeks. Laudable is a new acquisition for Blackfinch over the last few months. It is a digital legal platform designed to help people with prenups and postnups, combining the use of technology, AI, and professional and those within the legal profession. It also takes in things, not only postnups and prenups, but it also takes in things like wills, trusts, and inheritance tax planning. It is a fantastic tool. I got a little bit of a demonstration of it last time I was in the office. I think it would be a great tool for financial advisors to take advantage of, and a really, really key way for you to support your clients' progress and spot wider planning opportunities. We are doing a webinar on this. It is hosted by James Brooker, who was part of our Blackfinch Ventures family. and has recently come back into the family. He is hosting a webinar along with our strategic director, Graham Robinson, on the 14th of July at 10 a.m. And I would really encourage you to take a look at it. It is quite a compelling piece of equipment, and I think there is some great opportunities for you all there. And we'd be keen to get your feedback on it as well. Okay, so that's me done. Please do fill out the feedback form. In order to get your CPD, you do have to feed the feedback form. I'm not seeing any questions come into the chat, which might be my technology failing me. But if you do have any questions, please do get in touch. We'd be very keen to talk to you. And best of luck to all the teams partaking in the World Cup. And who knows, maybe this time it really is coming home. Thanks, guys.